Hello traders, welcome to your daily market update for Thursday the 18th of June 2015. Overnight it was all about the Fed, but we did see a 200 pip rally in the Great British Pound. The pound rallied 200 pips on the back of exceptional average weekly earnings data that came in at 2.7 as opposed to the expected 2.1%. That was the star of the show. And also the Bank of England's minutes did state that they were identifying the average wage growth accelerating, and the market interpreted that as potentially the Bank of England will need to move to a tightening policy ahead of what they previously thought. So that did help support it. And of course, later on in the session, once we've seen the Fed disappoint the market and the US dollar come under some selling pressure, the pound continued to rally, and it did break some major resistance levels, and I'll talk about that soon as well. But back to the Fed. The Fed actually provided no clear timing as to when they're going to raise rates. They downgraded 2015's GDP forecast, as I mentioned yesterday, and expected, and the market sold on the back of that. They were just disappointed that they didn't get any clear timing as to when the Fed would be raising rates. But the reason I don't think the US dollar long position is dead is because that's as far as the negative data really goes. The market was just disappointed in what they got. They were hoping to get some information on when the Fed will be raising rates, and they were asked many questions to Janet Yellen in every different possible way to try to get it out of her, and she just wouldn't budge. In fact, she was very clever in the way that she delivered the speech to try and maintain very subdued market reaction, and she's really was just trying to prep the market as to what's got ahead of us. She spent a lot of time downplaying an interest rate hike, saying that you shouldn't be focused on the actual rate hike itself or anything like that, and she said a lot of repetitive times that she won't be raising rates in consecutive meetings like the 2004 tightening cycle. So she spent a lot of time prepping the market, hoping that when they do raise rates in the near term, the market won't overreact. And she really spent a lot of time there. So the reason I think that it could be positive is the rest of the data was all bullish for the US dollar. We had 15 out of 17 Fed members suggest that they believe that we will get a rate hike in 2015. If you look at the dot plot from those members, it suggests that there's going to be potentially 2 rate hikes in 2015, meaning September and December. Personally, I'm not sure whether that'll be the case, but it is a very bullish indication that the Fed's voting members are all in favour of a rate hike, and if you were to take the average of all of their opinions, it would actually suggest that 2 rate hikes would be possible. Yes, they lowered the 2015 GDP forecast, but it has to be bullish because they did raise 2016 and 2017, and we all were aware that 2015 had to be downgraded because the Fed didn't allow for the Q1 slowdown in the economy, so that had to be adjusted. So it looks like we're going to get a rate rise no matter what. The Fed was just prepping the market, and they were a little bit disappointed by it. So I think it's a buying opportunity to buy the US dollar for those long-term trades at much lower levels, and I think that in the coming months you're going to see the US dollar actually be supported a little bit again. Now the US dollar has fallen, and I'll get to some technical levels, and we need to quickly chat before I move off this calendar. The New Zealand GDP came out very, very bad at 0.2% as opposed to the expected 0.6%. The New Zealand dollar is really underperforming the market, and I believe it's going to continue to fall. This is the New Zealand, this isn't the New Zealand, this is the US dollar index, and as you can see from the daily candle, it has fallen, and we will now be looking for it to probably continue to slide and potentially find support around the recent lows at 93. We'll have to wait and see. It could find support ahead of that, as I do believe that the market will be thinking about what Janet Yellen said and the fact that it isn't so negative, and that's why we didn't see a widespread wild sell-off as such. But we could see it undergo a little bit of pressure in the coming sessions, but nothing to get too worried about. And as I said, I think the lower the US dollar goes, the better the opportunities are to get in at lower prices. Let's go and have a look at the charts, and you can see the New Zealand dollar, once it loads up here, has sold off quite heavily on the back of the weak GDP, and I believe it's going to continue to break through them lows, and we're going to see some lower prices. even despite the weak US dollar today, with the New Zealand being sold off like this, I'm sure that if the US dollar found some support, we're going to see this falls accelerate, because it was a very bad result. We've got an interest rate cut, we've got very weak GDP, and it's nothing but downside for the New Zealand dollar. The Australian dollar has remained range bound, but it's undergone a little bit of pressure as a result of that New Zealand. We are still range bound between the 78 cents and 75.5 cents. I'm still a believer that we will get a breakout to the downside, but maybe for now we will remain within the range, and we could possibly see the odd breakout to the upside if the selling on the US dollar continues and we don't get any weak data coming up in the near term for the Australian dollar. So it's range bound. Don't get too excited for those trend plays unless you are willing to hold it for the ultra long term, and then I'm still a bear, of course. The Euro dollar did bounce on the back of the data from the Fed. We didn't break out of the resistance levels, and you can see we've made our way up and tested this resistance here at $1.13, close to $1.14, and I think that we're still waiting to see what's going to happen out of Greece. And before we get too excited, I think that things are going to remain pretty subdued with this pair and be driven off the back of economic or political risk, really. The Great British Pound, as I said, smashed through. It had a 200 pip rally, smashed through the major resistance level. It is still flirting with it, and it could potentially pull back. But the data that's been coming out of the pound, it is one of the stronger pairs right now, and probably going to continue to be one of the strongest pairs. You can see here on the weekly chart, we do have a move moving from A, B, C, finding support off the bottom here at $1.51.5, and now moving through to an extension level. The next, we don't have a lot of resistance for the pair, and as you can see here on the weekly, the major swing higher is a long way up. Whether we get there or not is going to be determined on how the Fed portray their plans over the coming month or two, and whether we start to get an indication from them that September is probably the highly likely that we will get an interest rate rise. But if not, I'm sure that the pound's going to continue to move higher. The US dollar versus the Canadian dollar sold off, so we have found resistance here at the previous historical support. As I mentioned the other day, if it did disappoint, we would fall away. It looks like that's the case, and we could see some lower prices. That Fibonacci is no longer applicable, as we didn't get the bounce from the Fed, and now we are really looking for the next moves lower. There isn't any major support. We do have a little bit of support through here at $1.21.5, and then once again at $1.19. So we'll keep an eye on those major levels. Obviously, keep an eye on oil prices to see if they are going to bounce, and if that's the case, we could see the acceleration to the downside for this particular pair. The US dollar versus the Japanese yen, you can see by this massive flame out on the daily candle that it does look like the price wants to move lower. I believe it is going to move lower, and it's going to present an opportunity to get in at lower prices. The first stop is obviously the low that we've seen through here at $1.22.5. 122, and then 122 is the major support that we have from the historical resistance level. If we do break through that, we could be moving down towards the 121s, 120s, and that would be some really good buying, I think, for the ultra long term. But for those of you who believe that an interest rate rise will come and support the US dollar, anywhere down around in this yellow box wouldn't be a bad position for you to add to your holdings. Well, that's it from me today. Good luck trading out there. We do have a little bit of data on the calendar that will be subject for the US dollar, and if it does improve, it may offer a little bit of support. However, if the data misses, I'm sure that the US dollar will continue its slide. That's it from me today. Best of luck trading, and I'll be back again tomorrow. So until then, trade well.